and welcome to the Business of Property podcast. I'm Stuart.
And I'm Simon.
And we talk every week about the reality of running property businesses. Simon owns Buy-to-Lets and created Patma, a leading portfolio management software system and a source of property market insights.
And Stuart runs a portfolio of co-living properties with a six-figure turnover.
And don't forget, if you would like to receive the latest property market insights, as well as any other useful bits of property information that we have available, please do use the link in the show notes to head over to our email Bop Tribe, and you will be added to the database, and we'll start getting you out lots of useful bits of information. Now, today's show is going to be slightly different because we do have a guest today, and that guest is Adam Watson of Sulis Properties. And based on a request that we sent out a little while ago, Adam emailed us about some challenges that he's facing in his current property business that he runs with his partner, Karina. And before we get into some of that, it would be good, firstly, to say hello to Adam and also let him to give a bit of background. So, hello, Adam. Welcome to the Business of Property.
Thank you for having me. Hi, Stuart. Hi, Simon.
You're very welcome. So would you like to just give us and the listener a little bit of background about yourself, Karina, and Sulis Properties?
Yeah, of course I can. Yeah, thanks. So we've been investing in property for about 3 years now. So it was a bit of a cliche background in some ways, which is my parents were involved in property for a number of years. I kind of grew up bouncing between different houses and doing kind of live-in flips and things like that. So I always had a bit of an interest and a bit of it always sort of excited me a little bit. But we entered the corporate world. We both have sort of corporate jobs, and it wasn't until we were close to buying our own property to live in London that COVID hit, and we pulled out of that house, and we thought, well, maybe there's another way. Instead of the frighteningly high prices that we were paying and going to be paying in London, and the amount of interest we were going to be paying even back 3 years ago on the mortgage, we thought, well, maybe it's better to invest our money we had for a deposit in starting something in property. So that first lockdown, we spent a couple of months just kind of really learning about property. So no like formal courses or anything, but listening to podcasts and reading books and things like that. And we realized actually maybe there is something in this. So we set up a limited company, Stulis Properties. And then by June, when the first lockdown was over, we bought our first property. And we invest in like the East Midlands, so kind of the Nottingham, Grantham, Lincoln area. And yeah, we got going quite soon. I think the interest rate we got back there was less than 3%, which is quite nice compared to what we're looking at now. But we got going and we bought our first basic buy-to-let. And then over the course of the subsequent couple of years, we've got 5 buy-to-lets in total, of which one we bought off market. So we did some the first property we liked so much that we did a bit of a leaflet drop in the local area, and we got someone who'd kept our little handwritten leaflet for 2 years, and then messaged us and said that we're selling. Are you interested in buying? So we said, yeah, we absolutely will. So we bought one off market, and then we're just buying one off plan as well. And we've also got one HMO which we've joint ventured with some friends in Lincoln. So I think we kind of had one eye on the future of potentially wanting to look for investors to get involved and provide the finance. So we thought, well, we'll joint venture where we provide the finance and just learn a little bit about being on that side of the fence. So we've got an HMO as well, and we've done a couple of flips as well. So one flip in particular we did quite soon after buying our first property, which was successful. It was a bungalow flip in the Grantham area, and that went quite well. I think that was a good opportunity for us to get our hands dirty, understand how things work, what we can do ourselves, what we can't do ourselves. I thought I could kind of remove everything in the kitchen, and by day 2 I'd sawn through a water pipe, and with an emergency plumber coming around, so it wasn't all plain sailing. But you learn a lot when you just get stuck in and get your hands dirty. So yeah, we're sitting on a portfolio now. There's a couple of purchases going through, but we're going to be sitting on a portfolio of 6 buy-to-lets, basic buy-to-lets, 5 buy-to-lets and 1 HMO, so a portfolio of 6. And we've kind of got to the point now where we've, I guess, run out of our own money. So we're still saving a little bit through our full-time jobs that we have, but that's not really bringing in enough for us to buy any more than maybe kind of 1 buy-to-let a year. So we're looking to still scale a little bit. We still want to scale. And I guess it's just understanding and having a conversation with you guys around what are our options in terms of how we can scale. Like investor finance is one way, but I guess there's lots of other options out there that would be good to discuss with you guys today.
Okay, well, before we get into that, I think we just need to put our foot on the ball, so to speak, and just acknowledge what's happened so far, because there's a lot of information there, and also you've done a lot in 3 years, and I imagine anyone listening that hasn't started would think 6 buy-to-lets and an HMO, and you've also mentioned flips, is quite a lot to have achieved in such a short period of time. So we're just going to just understand a little bit more about that so far. So you currently own 5 buy-to-lets, and you're in the process of completing on a 6th one?
That's correct, yeah.
And I would think the listener's quite interested in terms of values of those sorts of properties. What sort of values are we looking at?
So we're looking at roughly around sort of 150,000. So the cheapest one we've bought is about 100,000. The most expensive is just under 200. So we found that's kind of a bit of a heartland, which gives us a good return on capital, especially in the area we're investing, and the rent we can achieve. The rent roughly on all those properties is between 750 and 900. So that provides a decent return for us. But kind of, I've got a very sort of blue personality, so I'm all in the numbers and the detail. And actually, like, we built a sort of business case at the beginning of this kind of process of investing in property. And that we kind of realised that probably around 150 to 160,000 with the rent we could achieve was kind of the optimal price. Obviously, that changes with the interest rates going up a little bit now. But so that's kind of the range of properties that we look to invest in.
I've got one quick question and one slightly longer one. So the quick question is, what type of properties are they? Sort of flats, houses, bungalows, that sort of thing?
So we kind of focus on ones that are newer builds, so ones that have been built in the last kind of 10 to 15 years, because we found just like there's much fewer problems with the properties and things like that. We've managed to find a couple of properties which are basically they're sort of maisonette properties, but freehold. So you obviously haven't got all the costs with service charges and ground rent, but they're small enough we don't have too many issues. So we have got a bit of a variety. So we've got 3 sort of smaller 1 or 2 bed freehold properties. Then we did buy a sort of bigger 4-bed townhouse as our second purchase, because we were thinking about going down the HMO route potentially in the future. So we bought a house that would rent well as a house to a family, but in the future, if we were looking to improve cash flow, we knew we could convert it into an HMO in the area we were buying. So a bit of a mix really, but all with a kind of purpose in mind for how it can help us grow the business going forward.
Okay, so I think actually my second question, you've kind of preempted a little there, which was going to be around what you do with the properties, as in, do you buy them just sort of ready-made and ready to go as a buy-to-let, or do you look to then improve them and do refurbishments and that kind of thing? But it sounds like if you're buying fairly new ones, you're going down the ready-made route.
Yeah, so the ones that the majority of them have been just ones that are kind of ready-made, ready to go, and I think, like I said, the first purchase was just to get us going really, and we thought we did want to look at properties that we could potentially renovate, but we didn't really have the experience at the start to want to get into that, which is why we looked at the joint venture. So the HMO we do have, which was in the joint venture, that was one that we have done some work to and renovated slightly, just so we can learn a little bit from people who do this a lot more than we do, so we could gain a bit of experience. And on the back of that, we did our own flip project. So I think going forward, it's definitely something we're more interested in looking at. Is like how can we develop properties and add some value to properties as well. So that's something we're looking at more. But I think we wanted our original objective from getting into property, which I didn't really touch on earlier, was quite long term. So it was buying a sort of sustainable portfolio of properties, which by the time we're 50, so I'm 30 now, so in 20 years' time is allowing us to maybe retire early at that age, rather than something which is necessarily about driving cash flow right now. So we thought it was better to go and try and buy some sort of newer properties in that sense. And when you have a little, fortunate enough to have a little pot of money that we'd saved up for our London house deposit, we weren't really thinking about maybe 2-3 years down the line when we would run out of money, but we're at that point now, and suddenly, the deposit for a new property, we need to make it work a bit harder. So, looking at opportunities to add value, obviously, is something we're keen to consider going forward.
So in some past episodes, Stuart and I have talked about what it would take to replace a salary with various property strategies. And we've looked at HMOs and flips and also buy-to-lets. And buy-to-lets sort of came out as needing quite a lot of properties to actually sort of replace a salary. Did you in advance do that sort of projection and work out what you would need?
We did, and it is a significant number. And I think because we were looking over sort of a 20-year time horizon, we thought that's actually a number we can get to. I think it was over 20 properties. I think we'd need maybe 25 at the cash flow we were generating when interest rates were lower, in order for us to kind of, I guess, replace incomes. But I think our objective has changed slightly, in the sense of we went from kind of thinking, well, but it'd be nice to retire by 50 to really getting stuck in over that first year in particular when we were investing in property, to thinking, well, we can do this sooner, right? Maybe Karina can retire, potentially in 5 years' time, and I'll be out by the time I'm 40. And we were getting quite giddy with the potential of property. But I think we've taken a slight step back now, and potentially as we've sort of matured on our property journey, and actually it's turned into, we both like working at the moment. It's good to have incomes anyway to support kind of mortgage applications and things like that. So actually we're thinking it'd be nice just to rebalance the sort of work-life routine. So instead of just quitting our jobs, it'd be nice to both work 4 days a week, or maybe it'd both nice to work 3 days a week. So we're looking at our objectives now as, how can we replace 1 day a week's worth of income every month without reducing our income overall? So how can property replace 1 day's worth of income every week? And that's the approach we're taking. I think from the 3 years we've been investing, we're both at a point now where the business is bringing in enough where we could probably both step down to 4 days a week and not see any reduction in income, which is a great place to be. And we both enjoy working, so we're not looking to do that in the near term. But that's kind of the way we're looking at it now, is how can we just kind of incrementally take more time off and rebalance our work social life.
Yeah, and it's an objective that many people have, myself included, when we start in property. For me, it was about flexibility, but of course, financial freedom is what many of us are looking for. But I think the first hurdle that you got to reminded me of an adage that I heard several years ago when I first started out, that I hadn't quite got my head around, which was, no matter how much money you have, it would always run out when it comes to property. And I remember thinking, well, that can't possibly be true because I've got £1 million. But of course, if you had £1 million, you'd be operating at a different level, and that would soon too disappear. And unfortunately, at the moment, of course, because we know of all the different methodologies, strategies that people propound in the property world, no money down and so on, people think that money lasts forever. But even when you're refinancing, in my experience and our experience, is that there is always money left on the table, because banks just don't want to take all the risk, and we're seeing that change. So just to underscore, so you'd saved money for a property purchase that you were going to buy in London, and actually you've been able to utilise those funds to go out and now get approximately 6 buy-to-lets and an HMO.
Yeah, that's right, and it was. I guess we during that process, we had enough for a deposit in London. It was just over like £100,000, and what we managed to do through the first purchase we purchased just out of COVID. So we refinanced that after 2 years and managed to pull some money out, because that was obviously a very fortunate time to buy it. During 2020 and 2022, market prices were increasing quite a lot, and also the main flip that we've done also generated a fairly significant sum of money. So although we started with that sort of 100k figure, we managed to, I guess, make a bit of extra money through the properties that we were investing in as well. So the total amount that I guess we put into purchasing properties has been slightly higher, but the sort of the upfront capital that we put in was around about 100 grand.
Cool. And then just a matter of understanding, are you buying these in limited company?
We are. They're all in our Sulis Properties company name. Yeah. Okay,
so you're buying them all in a limited company, and then the final, just really for the listeners' benefit, is understanding, given that you're both still in full-time employment, have you had any challenges getting borrowing? Because that's something I often hear about, because myself, I haven't had a job for a little while, and that sometimes presents issues for borrowing. I mean, there's always routes, but have you experienced any challenges, obstacles buying through the limited company?
We haven't really, and to be honest, I might have a slight bit of ignorance here because I haven't purchased in my own name before, because we only rent in London. So I still only rent in London, so I've only purchased in a limited company. But aside from paying slightly higher interest rates, and obviously then having the sort of rigmarole around having to get personal guarantees and things like that, I mean, there's a bit more admin that's involved, but we haven't had any major problems. We've got an excellent broker. We've kind of one of the first things you learn when you talk to people about getting into property is get your power team sorted. So you get a good broker, and they sort of support you on that journey. So I wouldn't say we've had any problems with getting mortgages to date at all.
Just taking a tiny step back to your sort of story and progression so far, one element of that was a couple of flips, you said. And talking about a power team, you're doing these flips remotely, I think. So how have you found that sort of process? Have you used a local power team? Have you been commuting lots to do the work on them yourselves? Or how has that worked for the flip projects?
So we originally chose the like East Midlands area because that's where half of Karina's family's from there. So her mum's based in Grantham, which gives us a good kind of base to be in. And especially when we started in 2020, we were kind of in and out of lockdown the whole time. So we just based ourselves a lot of the time in Grantham, and we could operate from there, which was good. So the main flip that we've done is a bungalow flip, and it was about 7 doors down from Karina's mum. So it was the absolute perfect first opportunity. So we spent the most of one summer based there. Going around doing as much work as we could ourselves there, but you still build. The most important thing is just networking and finding the right electrician, the right plumbers, the right plasterers, and things like that. So we spent a lot of time kind of networking with Karina's old school friends that might have used plumbers before and things like that, just to get that kind of power team. But we did spend most of our time close to the projects that we've done, which obviously helps a lot. I think we had one experience where there was one trade that was in the property doing work whilst we were based in London, and it was quite a stressful experience, given that what they did wasn't necessarily exactly what we were wanting them to do. So it creates difficulties when you're remote, even if you do have local contacts like parents or whatever who can support. It's never the same as being there yourself.
No, definitely not. Just in terms of your selection of those properties, and I think already we've got an understanding that you've done a lot of thinking, or more thinking than most. Back of my fag packet says currently your buy-to-lets are gross yielding anywhere between 5 and 10%. That's even simple maths for me based on the numbers you've given us. But is that something that you look at? So, for example, I always talk about the fact that for me, with an HMO property, if the gross yield is not over 10%, it's generally not a property I'll even start looking at. Are those criteria that you've used for your early property investing?
Yeah, it is. I think for me, that's just it's a proxy about whether gross yield is something I'd look at just to have an indication as to whether it's a property we want to even consider going forward with or even viewing. Net yield is something which is a bit more relevant, but obviously a bit harder to calculate. But the main KPI that we would use is return on capital employed. So we put all our kind of numbers through there, all your costs as far as you can, making estimations for things like maintenance and letting agent fees. We outsource all the letting side of the business to local agents as well, and then we have a return on capital employed number that we're looking to achieve, and that's normally between kind of like 3 and 8%. That would be in the ballpark of what we'd be willing to consider. So that's the main metric that we tend to use, and kind of built little models which help us do that on an automated way. And it allowed me as well to understand, based on the value of the property in the area we're looking at, the rent I know it probably can ascertain. It's very easy to then just kind of know very quickly whether or not it's something you'd be looking to progress or not.
Yeah. And there was one thing when we read the background which made me smile, because it's something I've done, and you see a lot from people coming into property, is aside from the fact that you've done a lot, we've got buy-to-lets, HMO, we've got flips, we've got off-plan. So there's a lot going on. And this is I'm speaking as someone that was doing an HMO, a flip project, and a house that we were extending to double the size at the same time. So I'm talking to someone that can empathise greatly with this. But have you got to a stage where you have got a specific property investment strategy that you're thinking about? Because again, your planning is quite long term.
It is, and you're right. I think as I alluded to before, I think our objectives have obviously changed over the time, and originally it was long term, so sustainable, kind of fairly new properties that can add income in the longer term is what we were after. The HMO approach was basically for us to learn, and it was during the period where maybe our objectives were shifting to, let's see if we can do this a bit quicker, and we're pivoting back, as I said, towards a bit of a longer term strategy, maybe an incremental approach where we reduce the amount of days we work. So with that in mind, I think our current approach is we want to carry on building that buy-to-let portfolio of reasonably modern properties that do rent well in decent areas with strong opportunities for capital growth going forward. And we know our heartland areas in the East Midlands where we can achieve that. I think the idea for us is to be able to generate chunks of money through flips. And again, we have like a sort of flipping like heartland in East Midlands as well, where we know, especially sort of bungalow flips, where we know how those can work, generate chunks of money that we can invest into our buy-to-let portfolio. So that's our current thinking, is how we build like a longer term buy-to-let portfolio. We're not particularly interested in more time consuming strategies at this stage. We're quite settled in London, and we're not really looking to move far from the London orbit. So I think going down the HMO route ourselves is probably not appropriate. So it's building something that we can keep long term, outsource the management of, and it's just a case of how do we generate that with income that's not just from our own corporate jobs.
How are you finding flips at the moment in the current market? I don't mean as in how are you looking for them. I mean, how are they looking financially and sort of as part of your business plan currently?
I find it quite tough. So again, there's still a lot of opportunity. At the beginning of the year, the market went very, very quiet, and the type of properties we were looking to buy in the area we were looking to buy, we just really weren't seeing anything at all coming on. Now we're seeing things come on, and vendors are willing to negotiate and willing to talk about reduction in price. But I think the issue we're finding at the moment probably is when we're putting it through a business case, it's what's the likely selling price going to be of the property done up, because it's very difficult in a slightly declining market, or at least a market which is very uncertain, to know, what will it sell at the end. And obviously that's one of the most important things to consider. So, it's easy when the market's increasing because you can apply a slight uplift, but even if there's no uplift, you still are adding enough value. Whereas I can add value now and potentially still not see much uplift if the property declines in value over the next sort of 5 months, 6 months or so. So that's probably the toughest.
Exactly. We're all experts in a rising market.
Yeah, exactly. But it's interesting because I've only been investing for 3 years, so it's the first time I'm going through a market which isn't rising. So it does make the challenge. We're learning a lot, but the challenge is quite tough to know when to make that call and work out a property for flip purposes is worth the investment.
And an interesting point on that, because Simon and I have talked about this in the past, but I purchased a property, as did Simon, I believe, but just before the 2008 crash. And so explicitly, have you done any research in terms of what would happen in that area if there were a decline in property prices and basically mitigating that? So, for example, looking at a 10% reduction in, let's call it GDV for the sake of argument, but your gross development value. Have you looked at that? So, okay, right, does this work if it's going to be 10, 15, or whatever this local area could look like in a year, 2 years' time?
Not specifically in the business case itself. I think what we always look to try and do is have a second or third exit, right? So, I'll always understand when we're looking for a flip project, well, what is the opportunity here if we were to just refinance it? Because we'd be buying a flip going forward with investors to buy in cash. So what if we were to refinance it? Is that an option? Or if we were just to rent this property and keep it for a couple of years, what's that option look like? So I think we haven't necessarily inputted like a depreciating sort of scenario into our business case as such, but I'll certainly know from, if I'm purchasing this property, I would have got quotes on what's the done up rental value, and would that be enough to cover the costs from a mortgage or an investor perspective, because that at least gives us another out in the medium term if we do need to hold on to it until the market improves.
Yeah, so rather than looking at could you cope with a lower price, you're looking at it from the point of view as if the prices drop, you'll just hold it instead, or take another approach. So yeah, for the sort of situation where you're finding you're running out of investment funds and you're now looking to external investors to come in, are you thinking they would help you potentially build the buy-to-let portfolio, or are you thinking they would help towards flip-based projects?
It'd be on the flip side. I think the buy-to-let portfolio, the margins probably aren't really there for us to be sort of sharing the wealth at all with investors. I think it's more a case of how can we generate chunks of money like through the flips to invest ourselves in the buy-to-let portfolio under our limited company. So it would be very much investor funds to support purchasing cash, renovating a property, and then in scenario one, selling that property and generating some profit for ourselves to then buy our own buy-to-let. That's the approach we'd be looking to take.
So we've moved on to investors then. So tell us a little bit more about your thoughts so far. So again, you've hit that wall that we all hit where we go, oh, if I want to keep doing this, I need more money, and I've run out of money. So What thoughts have you had so far on this?
So I guess the first thing we were thinking about, and again, this is all through kind of just the research we've done, we've got a very good Nottingham property network as well, which is one of the areas we invest in, asking a lot of people questions, reading all the books and listening to the podcast. It's like the first question is, do you want a joint venture with someone, or do you want someone to angel finance, right? So you're looking just to have a more transactional relationship where they get an investor gets a rate of interest for a period of time, or are you looking to really sort of get into bed with them and set up a limited company or whatever it may be in the longer term? And for us, with our sort of more flipping strategy with investors, it's very much like we're looking at a fixed term period where we'll provide a rate of interest in that sense. So that's really I guess the first thing is understanding what was our strategy with investment. And I think interest rates, fixed term interest rate, is the way we're looking to go. And then it was a case of reaching out to kind of your close network, your close colleagues, close friends, family and things, and understanding, once you start talking about possibility of investing, especially with, the some of the successes we've had in the 3 years in property, people have an interest, and you realise people actually, there are people out there who do have a bit of money saved that they don't know what to do with, especially, a couple of years ago where you were getting pretty much no interest at all. People in the bank, people were more interested in looking for alternative ways to generate some return on their money. So we've had some people sort of put their hand up and say we'd be interested to get involved, and built like a small prospectus as well, which kind of takes people through who are kind of new to property, takes them through what we'd be looking to do with their money. And we've even had a contract drawn up which obviously it's just written by our solicitor to kind of make sure that the whole thing is quite watertight and has all the relevant legal terminology in it. So we've gone quite far down the line in terms of I guess setting ourselves up for investment, and we've had a couple of people who are investing with us, but it's a case of how do we, I guess, scale that a bit more, because we're in a place where we want to buy a flip in our sort of heartland pricing of 150 to 200 grand, which requires quite a lot of money, and people necessarily haven't got that level of funds that they're willing to commit. So it's how do we get multiple investors, or people who are potentially a bit more high net worth individuals who can fund the whole projects, and that's kind of where we're at. So we're set up for it. We're just waiting for the demand to come in.
I think I'll come back to your sort of question around investors or number of investors and approach there in a moment. But just looking at what you have done, you mentioned that you were investors, as in you put the money into a project for the HMO that you have and you're involved in. How did that go? How did they find you, or did you find them to do the other half of it for you? And how is that structured and worked out?
So it's it's a friend of Karina's, or a couple who are a friend of Karina's who invest in a particular area, and they've been in the HMO space now for a number of years. So they have the expertise, and she focuses on it full time as well. So it meant that we had someone who was dedicated to put the time in and the expertise, and we were putting the funds in. So we structured that one as a joint venture. So we set up a separate limited company, and we bought an HMO, and it was very much like a long term play for us at that stage. And it's doing really well for us. It's very low effort on our part, which is exactly what we were expecting from it. There haven't been any sort of issues at all in terms of the relationship between us and the other couple, and it just sort of ticks over nicely for us. So again, something which is cash flowing better than our buy-to-lets. It's helped us learn a bit more about how HMOs work and the kind of costs that are involved in HMOs. So it's helped us understand a new strategy, and it's probably not something, because of where we're based and the lack of time that we have with our jobs, it's not something that we're necessarily looking to do ourselves as the experts with the time, but it's definitely something which has been really worthwhile to help our understanding of that strategy, and it's something which we hope is a long-term approach with the other party.
To underscore what you've already done, so you talked about the fact that you're already in a property investing network, Nottingham. You're clear on what you want, and in terms of the type of investment, i.e. whether it would be joint venture, special purpose vehicle, and so on. And I think that is probably 3 steps ahead of where a lot of people are, because a lot of people know they want money, but they don't know specifically how. And also, you're already talking to people, so you've already got people interested. And your next question is around scaling that. And my sort of view on this is, having done it for a while now, is, and I've worked with all different types. So I've worked with people that have given me five figures, like 10,000, 50,000, and I've worked with people that have given me six figures plus. So my mindset now is very different. Is that if you want money, it's there, and it's a very different mindset. And the other element I think that I've learned over time, and having spoken with lots of other people as well, is that, and I'm not saying you're one of these, but is we often come into this potential relationship as feeling like we're someone that's coming out with a begging bowl. We need something. And actually, over the years, I've realised that the investors, so I've worked with a couple of quite high net worth people, and they have a big problem, which we all want, but they have this problem, which is they've got quite a bit of money and they want to put it somewhere without just leaving it sitting in the bank, or, and they've done various other things. And that was a real shift for me to realise that I'm not taking, I'm giving. So the mindset is, actually, we're going to give you a really good rate of return. I mean, even now, because we know that the banks are very slow at adding the Bank of England rate to savings rates, slower than they are to adding it to lending rates. And most people I've spoken with are amenable to whatever the rate is. Let's just say it's 8 to 10%. So if you're offering 8 to 10%, there's going to be a lot of people who are very happy with that. In terms of going from 100 to 200 and so on, for me, that's just a relationship building exercise. And the great thing from your perspective, from Sulis Properties' perspective, you've already got such a huge amount of experience in the last 3 years of having done what you've done. So you can now go into a room and talk about what you've done and how you've done it. And essentially the return is just what someone else is going to get. That they just need to know that you've got the credibility to do it. And then for me, without simplifying it, it's just kissing as many different frogs as possible. There's a story that I always tell, which is I'm back end of 2017, I got around £250,000 worth of investment from a couple of different investors. And someone said to me, that happened really quickly, happened in the last month. And because it all happened at once, it all happened in the month of November. But I said to him, yeah, but one of the guys, I was meeting him every month for a coffee for a year and a half. And I talked to him about so many different things that I was doing. And it was just the fact that at the end of the year and a half, he was finally confident in me, because, we can talk about having integrity, having values, and I will do what I say I'm going to do. But of course, there's 101,000 other people saying the same things that unfortunately don't do those things. So it's the credibility thing, so as boring as it sounds, you're doing all the stuff that I would suggest to do, which is actually just building that credibility. And, could you spread it across a couple of, if you needed 100, 200, well, could it be 4 people with 50? Because 50 grand seems to be a very simple number for people to understand.
Yeah, I agree, and I think that's probably the mindset shift that we need to do. That you articulated it really well around. We're going to people saying, we're not saying this, but can you do us a favour by lending us some money to invest in property? And actually, that's not the right approach. It's actually, we've got an opportunity for you to get a better rate of return than you can get in the bank or wherever your money currently is. And I think that's a mindset shift. And I think hopefully that just comes as we feel more confident about the journey we've been on and the experience that we've got. So yeah, that's absolutely something that I think we probably need to shift our mindset with. And I think talking to as many people as possible is something which I think even between Karina and I, we probably struggle with a little bit. Like I am very passionate about property and like to talk about it with as many people, whereas Karina's a little bit more like, I guess she's very modest and she doesn't want to bring it up so much, especially not at work and things like that, around the journey we've been on. And I think it's funny when you start opening up about something like property, people do say I've got a little bit of money set aside, or I've got a buy to let myself and things like that. It's funny how many people either have an interest or have an investment in property itself. And I think the final point around being coming across legitimate. So we've got an Instagram handle, and I'm really bad at posting on it, and I should probably be better on that than I am. But I kind of see that as our property CV. So what we do document on there is all the properties that we've purchased, and we have a lot of pictures about the work that we've been doing and things like that. I mean, I don't use it to generate interest the whole time, but it does mean that it's something to point people at, and at least show that, by the way, we are legit. We've done a lot of projects. We've got our hands dirty. We've got experience, and so that's the way I see it. As something which is more like a CV than a always on social handle.
Yeah. As you say, I think it's really good to have that sort of online proof, if you like, that you've been around for a while and you've been doing things and doing the right things. You mentioned that you've got a really good Nottingham property network that you're part of, but I wonder if perhaps you could also, and maybe you're doing this already, look at networking more local to yourselves in London, partly just because you'll find different people, but also because it's closer to you, so presumably it would be much easier for you to get to be involved in. And then as well as property groups that you can go and network at, have you considered going to just local business networking groups as well? Because certainly when I've attended those, as you say, you get talking to people, and it's amazing how many you find who have got a buy-to-let stashed over there and did a flip project last year and things like that. And you just don't expect it. But yeah, it's all about just going out and finding more people and meeting them and chatting.
Yeah, it's a really good point. We haven't gone down the sort of business networking route. One reason for that is because I try and bring it up in kind of like conversations through our work anyway. And so through the jobs that we both have, we have quite a wide reach in a couple of different industries. So I feel like we get a bit of that. But that, you know, we absolutely probably should be extending our reach within the London area. I've been to one or two property networking, and it does feel very different doing that in London versus elsewhere, because the market is so different. I think it's more of a scale thing, to be honest. I feel like, you know, you feel almost a little bit inferior going to a kind of London property network meeting where they're talking about, you know, projects and, you know, like returns which have an extra zero on compared to what we're doing. But I think it's probably something we should be doing more of. I see our kind of like investment life in the East Midlands is very different to our kind of like London personal lives, but there's probably a bit more of an interplay that we should be looking to integrate, if not just to learn more than anything else.
And the final point I would say on it is given your kind of approach, your structured approach to everything else, is also thinking about who are the people that you're talking about now that are already interested in. And given what you've just said, well, okay, so our market is Grantham, it's Nottingham, these are the property values, and this is what we need. Who are the target investors? So we don't have to necessarily go down the avatar route, but ideally, so again, what I did was certain investors seemed to want to work with me, and I thought, well, actually, why don't I just speak with those? Because they're the ones that seem. So for me, it was, you know, we called them C-suite. So it was, you know, chief executives, it was CFOs, it was so on. Owners of businesses, usually between the age of 45 and 55, had children that were grown, and so on. So then I had a target. So then I knew kind of like who I was talking to and what they would want. And then actually the messaging was just really clear. And you've already talked about prospectors. And then once you know who you're talking to, so again, in another part of my business where I'm looking at, where I do basically a rent-to-rent side of the business, the people I deal with are always very similar. So for example, if you're talking about those people that have got pots of money, what's the biggest, most important thing to them? Usually security. They just want security. So if they're going to put 20, 30, 50 grand with you, I just need to know I'm going to get it back. It's my pay, you know, I've been keeping it, you know, so again, just having an understanding of who your target investor is gets you really clear on your messaging to, you know, out within your prospectus and all of your activity.
Yeah, I think we're probably a bit too broad brush at the moment. We have a prospectus for anybody who wants to invest with us. And it's funny, I do a lot of, in my day job, I do a lot of sort of segmentation and things like that, but I haven't even considered that in the property sense. So I think there's still a way to go for us to, I guess, commercialize what we're trying to do in property. And it's probably a good point around learnings you can take from your day job. If you have a commercial job, what are the applications that you can bring into property? And I think segmenting the people that you're going after from an investment perspective is definitely a good shout.
Yeah, and it's so funny because, you know, very, very similar. You know, I've done lots of things in marketing, data, segmentation, all of these, but for some reason we come to a new sector like property and we just think, yeah, let's just forget all of that, even though most of it is still very highly relevant to what we're about to do. And so the second challenge then, as we just sort of get into the final straight of this conversation, was surrounding your flip properties. So do you just want to tell us what your sort of challenge is around that?
Yeah, I think It's probably, again, it's one that we understand what we're going after. And I think we've probably covered it with one of Simon's questions before around it's probably having the confidence in knowing what the end value of some of the properties would be. So we have a heartland of kind of bungalow flips, and we know exactly how they work. We know exactly the price we're looking to pay and the kind of work that's needed. And we know those kind of projects tend to sell pretty well, and they tend to also have a fair amount of demand just because people are not building bungalows anymore, right? So there's an older demographic who maybe are slightly less sensitive to the current kind of macroeconomic conditions. So we find that's probably a slightly less risky type of property to invest in versus others. So I think we understand what we like to invest in. The main issue has just been having the confidence in the numbers that we're putting forward. When we're using our own money, if we mess it up, we're only messing up the money that we have. Whereas I think it's the confidence when it's someone else's money that you really want to make sure that as far as you can that you're putting together a business case which de-risks their money as much as possible. So the type of property I think is fine. It's more just having the confidence to know that we're not going to do anything awful.
Yeah, my quick tip on this, and we've talked about this many times on the podcast. So I bought a flip in October 2019, supposed to be a 6-month flip. I still own that property because we still can't get rid of it at the moment because of external wall survey issues. But that's another topic. So we've already touched on the fact that if the worst is to happen, can you live with that? And you've already talked about multiple exits, and that is one of the key tools of a property investor. Is like, for me, is always having 2 or 3 different routes out. But we're now talking about investors. For me, in my situation, I'm not I am lucky, but I've developed a relationship with an investor where this worst case scenario. So he gave me some money, which was going to be for 12 months maximum. It's now 3.5 years, and we're not talking about an insignificant amount of money. We're talking about it's a good 6-figure sum because this property is in London. However, we had to get that stuff out on the table very early on. So, okay, look, this is a flip. This is my plan. Here's my presentation about why this is going to be great. And this is why it's all going to happen within 11 months. However, if it doesn't happen, can you live with the fact that we might have to hold on to it? These are the things we're going to mitigate. Now, the truth of the story is because he trusts me, it was all fine. And, of course, he's still earning interest on that money. So when we do eventually sell this property, I don't think I will have made any money. However, I'll have learnt a bloody lot, a lot about investing. So for me, that was a key one. It's just, if you're going to use investor funds, it's like, this is all the great stuff. But I think any investor worth their salt really wants to know what happens if it goes wrong. And it's the plan for that.
Yeah, and I think ultimately, it sounds like it's about being upfront about the possible downsides, and no investment is completely risk-free, and property's the same. So I probably just need to have more confidence that that investors will be willing to have a dialogue if things don't go completely to plan. Then as long as they're still getting their money back at the end of it and a return in the interim, then it's not necessarily the end of the world. It's probably something we just need to be more conscious of, that if things don't go plain sailing, that's not necessarily a major problem.
Yeah, and you've talked about that. And I don't know many investors, depending on the value. I mean, if you're talking about 10K, 20K, maybe not. But if we're talking 50Ks plus, I don't know many investors that aren't going to start talking to you about first charges, personal guarantees, etc. So they're already planning for that. They know. And I kind of partially blame the property marketing industry, because we know that, they're so keen to pump all the positive messages of, replacing your salary in 6 months and so on, that we think that, that it's all sunshine and rainbows in property land. Whereas actually, investors and ourselves know, anyone that's been in property for more than 6 months knows that there are going to be massive challenges ahead. So we have to prep for that. And most investors I know are planning to lose money. Like this investor I know, and he's never told me this explicitly, but when I look at his spreadsheets, I pretty much know that essentially he's got half of his investment back through the interest I've given him. So I think from his perspective, okay, I've now got half a risk that I had. I want my money back plus the interest still, but actually if Stuart goes belly up and his company disappears, my risk has just reduced. So all it really is taking that. And of course, you're you're going to go out there and be as confident as you are and about how successful it's going to be. But actually, this is what would happen. We'd probably have to hold on to a property for 1 or 2 years. But actually, hey, we'd pay you we'd pay you any profit from the rent. We don't make money, but you're going to be satisfied for 24 months. And it's just, I think Simon and I talk about this a bit. But you talk about you have the divorce conversation before you get married, because that way you're both in a good frame of mind, rather than if it starts going wrong to have a difficult conversation which feels a bit awkward. At least you've planned for it in your loan agreements and whatever else.
Yeah, I think that's a really important point to not miss when you are setting up a joint venture. So, the joint venture we've done on the HMO, we had a lot of very awkward conversations up front about, well, what if this happened? What if this happened? And I think it puts us in a much stronger position now to know that if problems were to occur, we are, first of all, watertight from a contractual perspective, but we've been through those scenarios. We know what will happen in those instances, which takes a lot of stress away. So it is really important to have those conversations up front. And I guess also just to have those scenarios that we talked about previously. So if scenario 1 doesn't work and the outcome from a flip or a project doesn't work, then what is plan B, what is plan C, to make sure that investor has as smooth a ride as possible in receiving the interest and getting their money back at the end of a period of time.
Yeah, and my experience is that when those things do happen, because they will happen, is you come out of those relationships even stronger. So, and again, I think it's the difference between thinking transactionally and thinking about relationships. And it's interesting, I have an investor that was very clear up front. He said, I don't want equity in your business. I don't want a JV. I don't want a special purpose. I don't want any of that. I just want to give you some money and I just want some interest, because that's all I want. And again, we were very clear on that front, and that worked for me. So it's being clear on what both parties want, because people might think, I might need to set up a special purpose vehicle for this, because you think that because a property course has told us that that's the right thing to do. And then you go into that, and then that makes things a lot more complicated. So it's about understanding, as you do, but speaking to the listeners, it's about understanding what you want from the far side of the equation. Because now I am less inclined to work with an investor that says, I want X percentage of your next project, because I know that I don't have to go down that route if I don't want to. So I can go to someone that doesn't. Whereas at the start, we might think we've just, whatever the investor says has to happen, when that's not necessarily the case. So in terms of your challenges, Adam, was there anything else in terms of this podcast that you were thinking about, or any key learnings, actually, that you might want to share with the Business of Property listeners?
I think not necessarily extra things to cover. I think it's all about how can you continue to scale when you've kind of spent your own money. And I think it's a good conversation just around how to target investors and how to sort of segment who you're going after, and just having. I guess it's having the confidence, and it's difficult to have confidence if you haven't got the experience. But to have confidence, if you've got a sort of proposition for investors, then knowing that they're after somewhere to put their money as well. It's not just a case of they're doing you a favour. It's having the confidence to be like, we can do you a favour. We can do something better than the banks. But I think in terms of learnings from our perspective, I wouldn't have any confidence whatsoever reaching out to investors if we hadn't been through the journey we've been through already ourselves. So I think where possible, it's really important to get that bit of experience. And yes, starting off with just a basic buy-to-let to understand the process of purchasing, but then trying to do a flip if you can, and getting your hands dirty and learning that you shouldn't saw through water pipes and things like that. It's all important learnings that you should try and go on before, because as I said before, you build that property CV, and it does legitimize you in the eyes of investors. And if we hadn't had that experience, then we wouldn't have had the albeit limited investment to this point so far. We wouldn't have had that. So I think it's getting as much experience as you can, either directly with your own funds or through joint venturing with others who have got more experience, is an important first step to make before you look to go down this route of third party investment.
That's fantastic, Adam, and I think that's a really good point for us to finish and wrap up. Just to talk about the fact that you've mentioned taking action, and I think that is one of the key elements that sometimes gets missed from people. And I've worked with people that did a number of courses, and again, education is really important, but but so is informed action. And, like you said, you can JV. You've talked about you've actually been on both sides of the equation. You've done the doing, and you've also provided the funding. So that is action. That is real direct learning. And my experience is that will teach people more than reading for days. I mean, I'm an experiential learner, so I like to do rather than read. But equally, I understand the importance of knowing some things before you walk into them. But that's great. So we wish you the best of luck, Adam, and to Karina as well in terms of Sulis Properties. And just keep doing the great work. You've made amazing progress so far. And thanks for coming onto the podcast. And we look forward to keeping an eye on your journey going forward.
Thanks for having me on.
And for everyone else that's listening, hope you've enjoyed that. Please do let us know. Reach out to us on Twitter @BIZ of Property. That's @BIZ of Property. And if you'd like to reach out to Adam, Karina, or see his Instagram page that he's mentioned on the show, just look at the links below in the show notes page and click there, and it'll take you straight to it. Other than that, we shall see you on the next episode.